Welcome to the NZ Everyday Investor. My special guest today, Konrad Hurren. How you doing?
I'm great, Darcy. Thank you for having me on the show.
This is probably the first time I've had what I would call a microeconomist join me on the show. It doesn't mean that you're really tiny economist. Maybe for our listeners, do you want to just describe what it is that you do? What is a microeconomist, and who do you work for, etc.?
Yeah, well, kia ora. So, my name's Konrad Hurren. I'm Econometrician at BERL Economics, Business Economic Research Limited. We're a very small consultancy based in Wellington. So, yeah, that's kind of my official job title and role. I guess we're a consultancy, private sector. We do a lot of economics, but it's not what you might expect an economist would do usually. If you think of an economist, you might think of someone working at the Reserve Bank or at Treasury. But what we kind of do is a private business or a government department will come to us with a problem and ask us, can you find some evidence or can you develop some sort of strategy to help us with this problem? Our role is really collecting data from lots of sources and bringing it together into a cohesive narrative that's valuable for the client.
So really what you're doing is you're gathering a large, diverse pool of data, and you're effectively allowing that information to speak to you to reveal insight, which hopefully is valuable for somebody who's making policy decisions or businesses. Is that who your effectively end users are?
Yeah, it's a lot of policy decisions. We have done a few things where we've kind of created, not puff pieces because it's a bad word for it, but like we would do like an economic impact assessment of a private business. Like we did one for Thermosash, which is a company who makes the kind of steel envelopes that go around buildings. And then other things we do is like a lot of evaluation. So that's kind of really, really tangential to economics. The value of having an economist come in as an evaluator is that we always work from first principles. It's kind of really ingrained into an economist that we work from the very beginning of something, and then we look at all the long-term outcomes of any decision. And even if we don't write that down, it's always our thought process. So I guess when you bring that into an evaluation context, it adds a lot of value. So we've done a few social return on investment evaluations, as well as other evaluations for sort of other programs.
And so with what you're actually interested in, with what you are interested in work and outside of work, like obviously you've got a keen eye for detail, and I think anybody who's into the data must be. You're spreadsheet junkie, no doubt. But what other interests do you have in the money space outside of work?
Yeah, so outside of work, like I really enjoy kind of reading about what's happening in global money markets. I enjoy reading about Bitcoin, thinking about Bitcoin, learning how that all works. I also enjoy reading economic history.
Let's talk about the difference between macroeconomics and microeconomics. I talk a lot about macro themes. I think it's probably increasingly very important at this current juncture in time for people to be aware of that if you're building wealth in this playground. But microeconomics is also very interesting. So tell me just broadly in your words, what's the definition? How do you differentiate between macro and micro?
That's really thorny. So, as you know, I subscribe to the Austrian School of Economics, and so the answer from that perspective would be, well, the macroeconomists are making up nonsense, and there is only one study, and that's economics, which is the study of human action. The practitioners of macroeconomics are the people sitting in Treasury, sitting in the Reserve Bank, and also those people sitting in the various retail banks who are called economists or forecasters or whatever, and they deal primarily with aggregates like GDP, inflation, and they figure out what direction those aggregates are heading. They dig into kind of correlations or relationships between those aggregates, and they look to understand the world from that perspective. In microeconomics, we would start from first principles. We would just postulate, humans act, we make decisions out in the world, and from that kind of other things happen. And we're one of the few species on Earth that kind of acts purposefully. We understand that our actions will have results. And so that kind of leads to, well, okay, if we can foresee the results of our actions, can we foresee the results of others' actions? So you lead on to that. And you kind of build up kind of what the world looks like from kind of that very first principle of humans making decisions. What's the value of an individual program, or how can we justify the link between a an estimate of the impact of something to an activity. Making those logical links and kind of linking that all through. That's the long answer to the short version, which would be they are different things for different purposes.
Yeah, that's a good answer too. So I want to just really highlight that the difference between Austrian economics and what seems to influence most economic thought, therefore policy today, which seems to be like a version of neo-Keynesian economics. That's my understanding of it, and I think you'd agree with that. But can you just tell me one sort of core thread of Austrian economics that kind of sums it up or encapsulates what it means?
Yeah, so I guess the key difference is Austrian economics is built from first principles, and it's built from acknowledging that humans make purposeful decisions in a world where we understand cause and effect. And it just builds up from the single person acting kind of on a deserted island. He's all by himself, and he's got some resources, and he's making decisions about what to do with those resources. And kind of from that, really basic story, you can add in another person suddenly pops into existence, and now the decisions between them change a bit, and we can kind of understand how exchange might develop, because they don't have time to do everything for themselves, so that one of them might take some time to catch some fish, one of them gathers some berries, then they trade. And then kind of from, again, this is really basic story, but you can kind of build that up by adding a couple of hundred more people. And then they'll make different decisions, and just understanding the economy from the smallest unit possible, which is the individual, and building it up to understand those decisions.
It's really well put, because the way that I kind of visualize it kind of works with most policy is that it's very much top down, but what you're describing almost feels like bottom up, right?
Yes, my perspective and the Austrian perspective is bottom up. It's from the things making the decisions, which is the humans, us. And I guess the train of thought that dominates policy decision making, maybe we'll call it neo-Keynesianism. That is very much top down. It's all about we've got these aggregates. We've got this thing called GDP, which we've added up all the production in the economy using our big data sources. If this moves, then the movement of this thing should cause something else. It's movements and aggregates that are used to explain movements in other aggregates, and it serves its own purpose.
Yeah, no, that's cool. So what we'll do now, I just want to show you on the screen here, for those that are watching it, the definition of what a yield curve is, because this is kind of one of the discussion points that I want to pick your brains on. We've covered this already on the podcast recently. What is a yield curve? Just a reminder for those that weren't listening, I think a couple of weeks ago when we covered this, but a yield curve is a line that plots the yields or interest rates of bonds having equal credit quality but differing maturity dates. The slope of the yield curve gives an idea of future interest rate changes and economic activity. So there's the official definition from Investopedia. And what I want to know from you is, obviously that's just a visual representation of basically data, and being an econometrician or is that how you pronounce it? Econometrician?
That is how you pronounce it, yes.
It sounds like a weird word, right? The more
it is a weird word.
Already semantic satiation kicks in pretty quick. But being an econometrician, when you see a visual representation of data, it's quite a powerful story that it tells you. So in your view, when an inverse yield curve happens, where it's a lower rate for longer maturity terms, what does that mean from your perspective?
It's complicated. So the yield curve, because it's the difference in the yields of long-term versus short-term bonds, usually treasury bonds, and it's usually the 10-year and the 2-year. So because it's the difference in the yields of those two instruments, it's kind of abstract anyway. And then you're not looking for kind of any specific point. Like, we don't actually care that the yield curve is at 2. We don't actually care that the yield curve is at 0. We care whether it's kind of going down or whether it's going up. So maybe it might be more useful to kind of calculate the derivative of it, and instead graph that, and then you could just say, oh, well, when that's positive, we've got something, right, and when it's negative, it's got something. But we don't. We just look at the general shape.
Right. So what you're saying, though, the derivative, you mean the rate of change of that. Yeah. Of that curve. Okay, keep going. Sorry.
Yes, it's in an unhampered or a free market. What you would actually expect is that the yield curve, if you could calculate one, it would be flat. It wouldn't necessarily be 0, but it would be flat somewhere, because simply if the interest rate is different in one sector of the economy than another, then you would expect businessmen to kind of go toward the area where it's larger and away from the area where it's smaller. over time, and that sort of arbitrage would tend to kind of flatten out whatever yield curve you calculated. But we don't live in that world. We live in the hampered market world where we have central banks, and so I guess the yield curve in our world, if it's downward sloping, then it's telling us that market participants, which are traders, lenders, maybe a little bit of people on the street, they are expecting that the central bank will increase interest rates in an attempt to slow inflation or price inflation. And so, the yield begins to turn negative, and indicating that they're expecting rates to rise. And then from the rates rising, we would expect maybe some sort of correction and a recession. A yield curve to be downward sloping would mean that market participants believe there's kind of a combination of two things happening, which is that economic activity is really strong, and so the central bank would probably start to increase interest rates, thinking, oh, maybe I can stop goosing the economy so much because it's doing well on its own. I can build up kind of this buffer for next time I have to goose the economy using interest rates. It should also be a time when price inflation is really high. So market participants might think, well, the central bank has a mandate to kind of fix price inflation by increasing interest rates, among other things. And so, the combination of those two things means that we should see a downward sloping yield curve, and that means there's expectations that the central bank should start to increase rates in the future.
It kind of can tell us quite a lot just from a simple little line, the direction of it, because if it is downward sloping, it means that interest rates will be high to combat inflation. But when you look at the longer term end, if that's dropping down, then you could kind of infer from that actually, because of maybe the higher interest rates or because of some other dynamics happening, most participants feel like the economy will enter into some sort of funk later on, where central banks will need to drop the interest rates to, like you say, I think you said, goose the economy again, right?
Yeah, so that's probably the most logical explanation for why an inversion, which is kind of the yield curve going negative, as an inversion, why that signals a recession. It's because it always comes after a period of sustained growth of the economy, which has been pumped by essentially free money. It's new money, it's pumped by the inflation, and so it comes at the end of that period. And if you increase the interest rates at the end of that period, what you're going to do is you're going to cause a reallocation, because people will decide, oh, well, now the world has changed. The investment decisions I made during the boom times, actually they're not so profitable. I'm going to sell them. And that happens all across the economy, all throughout all different sectors. And that causes unemployment of all sorts of resources, including humans, which we would usually associate with a recession.
So just kind of slightly tangential to this part of the discussion, and kind of bringing with us the Austrian School of Economics, thinking about intervention, regulation, central bank intervention via interest rate adjustments. How Austrian is that? Like, it's not really the invisible hand of the economy, is it? And in your view, as an Austrian economist, would you feel like that type of intervention possibly causes more harm than good?
That's a thorny question. I think there's been a lot of really, really powerful scholarship showing. We've got work by Murray Rothbard, we've got work by Hans Hoppe, multiple pieces by Hayek as well. And we've got probably the best case of it, which is Murray Rothbard's The Case Against the Fed. And that's written from the perspective of an American economist. He wrote this case against the Fed, which is kind of laying out what the world might look like under a hard money standard versus what the world does look like. Because Murray Rothbard actually did a lot of work on welfare economics, which a lot of people don't know about. So he used that to describe how the welfare of the economy might have been different under a hard money standard, and kind of built that case and came up with a conclusion. But I guess what I really want to emphasize is that economics is a positive science. We can only tell you what is. We can't tell you, it's not normative. We can't make a normative judgment of what is better, what is worse. It's just what is. And so I guess the world we have at the moment, which is where central banks can control the money supply to an extent and control the interest rates to an extent, we have that world, and we know the effects of that. And we also can understand, based on first principles, how the world might look like under a system where we don't have that intervention.
But I guess you can kind of almost indirectly infer that by probably as like a derivative of just taking snapshots of where we're at, like what is during a certain period of time, and then talking about a rate of change in any certain direction. You can kind of draw conclusions that way, presumably, right?
Yeah, you can. And actually, a lot of people in the Bitcoin space, especially on Bitcoin Twitter, a lot of there's the new academics. I think they're just doing their thinking. They're not in any official roles as academics. A lot of them are anonymous, but they're doing their thinking publicly, and they're explaining, this is how the world would look like on a sound money standard. We've got work like that by Saifuddin Amus, who wrote the fiat standard. I'm not sure about the...
Is he kind of explains how money creation works in the context of mining, which if you kind of understand Bitcoin mining a little bit, you can kind of really take that leap and understand how money creation works a little bit better, because most people kind of have different theories, or they've been taught, or they believe different views on banking, but there is a completely alternative viewpoint which seems to be growing in its popularity. Great book though, totally recommend it. Have you read the Bitcoin standard one that he's written as well?
Yeah, I have. That's fantastic.
Yeah. No, that's cool. So let's kind of keep on going with this macro sort of discussion. I know I'm kind of making you kind of go from your econometrician sort of space into the macro space, sort of make you go there. Going back to central banks, right? So I just kind of always visualize this little puppet master in the background. They're trying to sort of navigate the whole, well, it's pretty much the whole worldwide economy now, right? They're trying to sort of keep us centered in the lane. And there's a certain amount of latitude, more or less money creation through expanding or contracting the money supply, increasing or decreasing the cost of it. I'm sure there's a lot of formal and informal other levers they pull, but it will work within a certain band, right? Like presumably you can push a string down so far, you can drop interest rates so far, and then it potentially could lose effectiveness. And that must be a massive concern to central banks. So I guess my question to you around this is there a point where there is less effectiveness by central banks, where they potentially lose control? Do you see that that's a real risk of losing control and therefore credibility?
I guess there's the lower limit of interest rate, which is the zero lower bound. So that exists in a world where we have alternatives to bank deposits, which we don't. We have cash. In that world, you can't push interest rates any lower than zero, because if you push them below zero for normal people, we will not just keep our money in the bank. We'll take it out and keep it as cash. But that's kind of pushing nominal interest rates down to zero, which you can't do. But you can push real interest rates far below zero, and we've seen that for the past 10 years, where we've had negative real interest rates. We've had, nominal interest rates have been 3, 4, whatever %, with price inflation running officially at 3, but it's like 8. Price inflation's been high for the past 10 years or so, not really as measured by the CPI, but kind of just as measured by everyday people experiencing what we're experiencing. We've had negative real interest rates for that long, and I guess I don't think there is any limit to that. What I think is more pertinent is kind of understanding that negative real interest rates cause consumption of our savings. And when I say savings, I don't mean, well, I sort of do mean kind of money in the bank, but it's kind of a more abstract way of thinking about savings, which is, well, if I produce things as an economist, I produce reports, savings should be thought of as kind of potential goods, or goods that exist kind of to sustain you through your production. But when you have negative interest rates, you begin to eat into those. And so that kind of causes a lot of distortions, which we see in the world. And I think this is kind of my thesis, and it's not proven yet. And I hope to find a way to prove it, but haven't yet. I think that's where this the whole concern of not climate change, but like there's a lot of people complaining at the moment that we work too long. There's people saying we consume too much. People saying that we're living beyond our means. And I mean, I think they've got things wrong badly, but I think they kind of at a very basic level understand that this world we've created of negative interest rates for the past decade or so is starting to eat into our reserves essentially, and so causing a lot of social issues.
That's an interesting way to frame it. I never thought about it like that. But like, I guess the first thing, just to make it really abundantly clear, is that we often talk about this potential event where we're going to have negative interest rates. But what we're talking about is we're actually really just talking about at the nominal layer, which just means the actual interest rate that you see in terms of the headline number, but not adjusted for inflation. So right now we have significant inflation, and I want to come back to that inflation story in a second. But we have significant inflation. So when you take that into account, we've been running into negative real rates for quite some time. But what I find it really interesting off the back of that is that that does cause human behavior to it changes our behavior because it changes the whole incentive structure. So that the headline numbers that you throw at us, they're going to do whatever they're going to do, but we sense what real inflation is and we adjust accordingly. So that kind of, I guess, really puts that pressure on the finite resource thing going on right now. Is that what you're saying?
I think so, or I think that's where that kind of idea of finite resources comes from. I will say that the people who are campaigning on that sort of train of thought, they're very wrong. The only scarce resource in the universe is humans. We are the only resource that matters. This is a central thesis by Julian Simon. He wrote a book called The Ultimate Resource. It's humans and human action and what we do that makes resources more abundant. We're really good at that. Like, one observation I like to quote is that in the 1800s, when we used to use whale oil to light our lamps, whales became incredibly scarce. Like, they were going extinct. It was bad, and it is bad. But then humans, being amazing as we are, and the price systems we have and the way we act, we found an alternative to that. We found kerosene, and that was an absolute amazing invention. And kerosene saved the whales because we didn't need to go hunt whales to light our lamps anymore. We made whales more abundant by finding kerosene, and we make cows more abundant by farming them. Yes, we made aurochs extinct. That was tens of thousands of years ago, but we made cows in general more abundant because we wanted more meat. We are the limited resource, I guess, in the economy.
And you mentioned this book off air before, Konrad, The Ultimate Resource. These are things that you just do not hear these days. Natural resources and energy are getting less scarce. Pollution in the U.S. has been decreasing. The world's food supply is improving. Population growth has long-term benefits. I know this is triggering people right now just listening to that. But that triggering is actually called learning, or that's what we used to call it. And so this is really important, right? Even if it's wrong. Like, I think this would be a really interesting read, right? Like, if you're smart, you'll figure out whether it's wrong. You don't have to guard yourself from that sort of stuff, do you?
Of course. I love that sort of reasoning. I'm very, very into Steven Pinker's line of reasoning too, although he's maybe a bit too utopian. But he's a great guy. And he runs a site with or at least he quotes a site with lots of statistics about how life is improving in general and things are actually getting a lot better.
Right. Yeah, that's interesting. Now, I want to kind of circle back a little bit to CPI, the Consumer Price Index, and this is probably more, I guess, in your field, because we're looking at data. And the CPI, just to maybe start with, what is it? It's obviously just like a measurement of what the prices are for a basket of goods. Can you take me through it at a high level, just what's in there, and does the basket ever change over time, that sort of stuff?
Yeah, I think so. So what I want to emphasize is that the CPI serves a very specific purpose, and it's designed for that purpose, and it's not designed for any other purpose. And the purpose it's designed for is officially monetary policy. It's in the Reserve Bank's. They've got a mandate to kind of keep the CPI inflation from between 1% to 3%, as measured by this very specific instrument, the CPI. You have to understand it from its purpose to kind of understand why it's created the way it is. And the way it's created is by Statistics New Zealand. In the past, it was literally just every few months they would send out people they employ to kind of mark down the prices of things across the economy, across New Zealand, like petrol and Patanui. Maybe we've got bread and Oakuni. I don't know. You've got lots of those sort of things. Anyway, so that all goes into their big spreadsheets. You can kind of build a picture of what the average consumer might buy, and kind of understand that, okay, this is probably somewhere around the average amount of money that an average household or average consumer in New Zealand is spending on an average amount of goods. So it's really, really abstract. And I guess why I emphasized that it has a purpose and it's built from that purpose is that because it has a purpose, it's not very useful for anyone else apart from the very specific people it's built for. When we try to think of what is an average price, we run into circular reasoning. If I were to tell you that oranges are $2 and napkins are $1, then what is the average price? Okay, maybe it's $1.50, but it's $1.50 of what? Orange napkins? No, that's silly. So we run into this circular reasoning where you've got an average price because it's an average price. But then it is kind of useful if you kind of understand kind of the conspiracy theory of history, which is Rothbard's wording. Understanding that behind all policy decisions are humans, and so if the humans behind policy decisions are facing data built for them, and they will make certain decisions based on that data, then maybe you should also look at that data so that you can foresee what decisions those policymakers will make that might affect you.
Okay, so I guess another way of saying that is that you can torch the stats to confess to whatever you want them to confess to, right?
You want to, sure. Yeah. Overseas, particularly in America, there's a website called Shadow Stats, or to give you an inflation rate that kind of more closely matches maybe some sort of real rate, or it's minus some sort of manipulation.
But it kind of highlights something, and if you go to shadowstats.com, you can get the picture pretty quick. But I've heard this referenced a lot as people try to, I guess, get people off of that reference point of the CPI, because just like a lot of borrowers obsess with the official cash rate, and they wonder and they try to make financial decisions, which I think is so dangerous, based on the official cash rate and where that might be going. Equally so, if you're making investment decisions or even consumption decisions based on the CPI, you need to understand that there's some inherent weaknesses. And what you've just unlocked for me, I think is really important, Konrad, because you kind of made it really clear that, hey, this is a specific tool built for a specific reason. Therefore, it shouldn't be used to actually say, hey, there's been 7%. That means 7% inflation, everything's gone up by 7%. No, it's not actually true. It depends on who you are and what category and what you're buying, what you're consuming, right? But talk me through what substitution means, because that's kind of one of the things that I find quite curious with the CPI basket of goods. It just assumes that if T-bone steak goes up, that we'll just swap over to sausages. Do you think that's kind of reasonable?
It probably matches human behavior, but I really think it's... I think it might be overstepping the logic of... I know the CPI is built for a specific purpose, but if you're really trying to guess what the average person will do and kind of going as specific as what they're going to substitute what for what, I think you're overdoing something. I don't know what it is, but you're doing something too much. I feel like there of course will be substitutions when things increase in price, but the average person, well, there's even less of something tangible and logical to hang on to if you're talking about the average person making an average substitution. It's just really strange to me. But it serves its purpose, and I guess that's what it'll.
Okay, well, let's kind of transition this discussion on to what next, right? Because I think if you kind of follow anything out there, there seems to be a growing crescendo of opinion that, hey, things aren't quite normal out there right now in so many areas, and especially when you look at just where interest rates are going worldwide, the alignment and just how that might actually trigger and usher in a depression, even almost worst case scenario. Like talk like that is starting to pick up, not because that's real, it's just that more and more people are talking about it, which really feeds into the overall Bitcoin narrative. And I've been quite passionate about talking about this for quite some time. I know you're really comfortable in this space as well. It's a natural fit for any Austrian economist, I suspect, as well. We have this finite hard money. It's digital, but it's like a hard money, isn't it? Starting here, like, do you see that Bitcoin is potentially a life raft for when this ship sinks?
I think it's a life raft now. Don't wait until the ship sinks, please. We need everyone. We need everyone we can. And I guess kind of what you were saying before, which is where interest rates are heading globally. This goes way back before 2020. This goes back to, let's maybe start this at 2008. So
Okay.
2008 happened. We had, as a result of the Asia financial crisis and the financial crises of the early 2000s, we had extensive money printing, new money being created a massive boom period. That massive boom period incentivized American policymakers to make various decisions, which created this mortgage bubble. The banks who underwrote a lot of the mortgages and created a lot of different financial derivatives, they were then sold to European banks who had their own incentives based on the huge amount of money printing which came before that. So one boom preceded this bubble in those assets, and that all kind of blew up when we kind of had a point in time where the people started to realize that actually these instruments are overpriced. Mortgages, people started making more delinquencies on their mortgages, etc., and the market started to implode. What should have happened is that the market should have been allowed to implode. It should have revealed how many people were swimming naked, I guess. We needed some sort of cleaning out of all the junk, right? So we needed to sell the junk. People would become employed. It would be a horrible time for everyone, probably last a decade. Honestly, it would have been awful. Would have been truly awful. And that's kind of why it was postponed, right? But we really needed that clean out to just make sure that the future could be built better, I guess. But that didn't happen. So nobody wanted to say, well, we're going to let a recession happen. Actually, probably a depression happen. And so it was postponed by, let's bail out these banks. They're too big to fail. Let's steal the wealth from future generations to make sure that they don't go down now and make sure there's no depression. And so what we got from that 2008 event and kind of for the next decade is, again, another period of monetary expansion, and there was an economic boom time. We've just lived through the biggest bull market in equities ever, and that's been caused by, again, that expansionary monetary policy, or to kind of paste over the events of 2008. And kind of in 2019, we saw the first time the yield curve began to go negative again, and so that was kind of the first signs of, hey, this money printing it's gone on. Well, market participants are now expecting this to kind of start reversing. And then in 2020, we had the emergence of SARS-CoV-2 causing COVID-19, and then we had the response to that pandemic, which caused another economic downturn. And of course, that economic downturn has been met by further money printing. So we've really just made this huge bubble of free money for the first people who receive it, I guess, because they literally create it. What that's created is a hunt for yield anywhere, which has kind of brought about these really strange conditions we see where people are paying, thousands, millions of dollars for monkey JPGs. Every market participant is just desperate for yield because there's no yield left, because we just have so much free money pushing down yields on every single asset. And I guess right now the world, again, it smells a lot like 2008. We need a big recession, depression, whatever you want to call it. I actually prefer the word depression because that's what is used by the earlier academics, Ludwig Mises, Friedrich Hayek. That they use that as a very specific word to mean a situation where resources, sometimes people, are becoming unemployed. It's not linked to any time period, but it's just, this is a bad time. But anyway, so we need one of those events to kind of, again, show who's swimming naked, who's buying the monkey JPGs for $30 million, who's doing all these silly things, and kind of clear those out. Yes, it's going to be incredibly painful. There's probably going to be massive civil unrest because of it, just because of how far it's gone. But it's necessary. But I really do think that it will be postponed again, which is even scarier because kind of coming out of the the events of 2008, what happened was this idea of the Fed put, which is that every trader in the world, you could make one bet, which is that the stock market will not be allowed to go down. And that's been true, because the Fed is just like, no, must go up, please. And I guess people are talking about, oh, the Fed put is over, whatever. No, it's not. The Fed put is still very much the play. The Fed cannot let the markets decrease at all, because from here, kind of what we've got is, at least in Western countries, we've got almost inverted population pyramids. We've got huge populations of people who are coming up to their retirement years. They no longer have any earning capacity left. They're not looking to earn income anymore. They're looking to live off their retirement, off their house prices, off their share market shares.
Right.
Yeah, there's just more of them now. And so I guess if any government around the world was to allow a large enough recession to happen to actually clear out all the nonsense, all those people are going to be wiped out financially. And the socioeconomic consequences of that will be cataclysmic.
So you're kind of like painting the picture of two possible events, right? So the central bank walking on a very, very narrow ridge line, and one little move to the left or the right, and it's absolutely catastrophic. So under both of those events, where there is some sort of meltdown event or some sort of hyper money printing event, what happens with Bitcoin?
Well, I guess in both those situations, Bitcoin just goes up. It's the perfect number go up technology. But I guess what's more interesting to me is, which is more likely, and also the fact that the money printing that will happen, how long can that be sustained? We talk as if like, oh, it's only 5 years away or whatever, but actually we have no idea how long that can sustain that. And what we've this is going back to what I said a lot earlier in the podcast about the effects of negative interest rates. It creates a lot of socioeconomic upheaval. It creates a lot of riots and protests. Just in general, people are just mad. And I guess that's a limit to central bank actions that not a lot of economists are acknowledging, and not a lot of policymakers understand. That actually the limit to what they can do isn't anything to do with the numbers. It's how much people will take, and I guess like we finally have a choice. Like we can stay in that world and kind of watch our wealth and our futures be kind of taken with these negative interest rates, or you can hop on the life raft, the big yellow life raft. What's interesting to me is I can send and receive Bitcoin. It's not anonymous, it's pseudonymous, but I can send and receive Bitcoin without anyone's permission, anywhere in the world. I can store my wealth without anyone's permission anywhere in the world. I can store it in my head if I wanted to. That's possible with using a seed phrase. And I guess that's the most powerful thing about it. Like we can finally store our wealth away from the system that's kind of, it's not crumbling around us, but there's kind of how long until it does. Like, from a Western rich country perspective, we're incredibly lucky. Like we can go out and buy a Bitcoin hardware wallet, and the post office won't stop it getting to our house. But some of us can ask our bank, hey, can you send my money to a Bitcoin exchange? And it will happen. In a lot of countries, where there's a lot heavier financial repression, those things just aren't possible. Like if you try and order a Bitcoin hardware wallet somewhere where they're really watching for people trying to exit the system, it won't get to you. And quite possibly you might just get arrested. Who knows? I don't know if it's that bad or not, but I'm aware that like people cannot get these tools.
Kind of makes you just wonder, like, who really is our government again? And what's the most important thing that they're trying to protect? I don't know.
That's definitely a subject for another time.
That's a dangerous subject, Konrad. Let's not even go there.
Let's not go there at all. But like my perspective is where interest rates are going is kind of they have to start increasing. And if not the official interest rates that will increase, what will happen is that the interest rates kind of in the market, because there's not only just the official interest rates, there are interest rates between the future and the present in all different markets, in all different sectors of the economy, and those interest rates will start increasing. And then as those interest rates increase kind of to certain points, we're going to start to see businesses move to different sectors. We're going to start seeing the dislocations that causes. And actually, even despite what the central banks do, maybe there comes a point where market forces kind of just defeat whatever the central banks do, and it doesn't matter. They can keep trying to push down the official cash rate. They can keep printing money, but maybe there's a point where the market just constantly absorbs it and just says, no, interest rates are higher. We're just going to make them higher. Well, we're not going to make them higher, but interest rates between humans actually making decisions are just going to be higher.
We love the idea of disruptive technology in a way, don't we? And we all want each of our specific components of our investment portfolio to succeed, but we often forget the environment that has to exist for that asset to be successful in. And when we're thinking about Bitcoin, especially, to quote another famous Austrian economist, Joseph Schumpeter, I believe it is, creative destruction. So we marvel at the creativity part, but we kind of we don't want to talk about the destruction part. But what you're kind of alluding to here, and the reason why I think this is kind of this is an interesting story looking at the price history of Bitcoin, because this kind of just shows how right now something can actually go pretty far before it flips from being a creative new thing into something that actually is destructive. And I would suggest that the destructive capability of Bitcoin, we haven't actually seen that yet, but it's probably highly correlated to price. What do you think about that idea?
So I think what we'll start to see is as the user experience of Bitcoin starts to get easier, which it has done over the last few years, it's amazing. The Lightning Network is getting easier to use over time. And also the new generation, like the kids who are like 10, 11, 12, whatever, the things they're seeing on YouTube, the books they're reading, even on Roblox, which is a really famous video game played by young kids, which allows you to essentially create your own games within the game platform. It's really interesting. I love that concept. So a lot of those games, like the kids are creating these things and they're calling them Bitcoin and they're talking about it. And so I think we're not going to reach this point where kind of the authorities say, okay, you can use Bitcoin now. Like it's just going to happen organically where people are just going to be like, oh, I want to buy pizza today, or hey, can you build me a website, or hey, can you drive me to the supermarket? Can you drive me to doctors or something? Well, okay, bro, can you pay me some money for petrol? Oh, how do I do that? I can use Venmo. No, I can use a bank transfer. Whatever. Oh, why don't I just send you a Lightning transfer? I've got this Bitcoin wallet that my parents set up for me. Gave me maybe $20 or whatever, a couple of thousand sats. Oh, I'll send you 100 sats for a ride down the road. And so it just happened organically, I think, from those sort of interactions.
Thinking far ahead now into maybe it is some sort of zombie apocalypse at this stage. Who knows, right? Because clearly there is a battle going on between two financial systems. One is a very centralized financial system, and one is kind of like, I don't know, like the best way I can think about it, it's people. It's the power of the people. It's pure democracy. It's pure free market. Who wins? Who wins in the end, Konrad?
I think if we don't win, it's bad. Humanity kind of has two routes we can go. A guy called Alexander Svetski has written a lot about this. I'm really, really down for this conversation. Like we can either go down the easy route, where we say, okay, you guys want to centrally plan things. You guys have every incentive to make it easier to centrally plan. So we know what you're doing. You're going to create a system where the decisions we can make kind of fit into a nice little ball. They're all in a list of decisions we might make because they make sense in this system, and everything else kind of just, it's not allowed, but it's just really heavily disincentivized. And that's kind of the central bank digital currency route, where we kind of, everything goes to the central bank and everything's collected and ticked off the list. This person's acting right, this person's acting good, whatever, social credit scores, it's all that sort of thing. That's one way we can go. And it's going to be easy. All we have to do is sit here and say, yep, we'll take that. Yep, okay, sure, we'll use your stuff, fine, whatever, it's easy. Convenience is good, fine. But then that leads to a really, really bad world. It's not dystopian straight away. Like, it's going to happen really incrementally, and we won't notice it. And future generations will look back and think, how did people live back in the 2020s? How come they were allowed to have cars? What decisions were made along the way that suddenly we can't? Or we can take the other way, which is really hard, where we actually have to understand sovereignty and self-sovereignty, and start to use the tools available, like Bitcoin, like peer-to-peer exchange, encryption, and we have to understand which buttons to press and when, and understand our role in that system, and kind of move humanity towards a world where we don't have so much reliance on kind of people with checklists telling us what we can and can't do, mostly what we can do, and then kind of disincentivizing what we can't do. But we move into a world where we make more of our own decisions, which is harder, have more responsibilities. Because that is a hard world, I think there's going to be a natural tendency to move into that bad world, which we really have to fight against. There won't be a fight of boots on the ground, guns waving, because honestly, like, the people win that. There are like billions of us, and there's very few of the others. Not all of us have guns, but the people that do, they do. And so there's just more of us. We'll probably win that sort of a fight. But I think the fight comes, there's a lot more subversion. So the fight comes in terms of distractions, like monkey JPGs, FUD campaigns, silly things like saying proof of work causes climate change. Be afraid of proof of work. Don't use this. Use proof of stake instead. It comes in the form of like creating an incentive structure where kind of entrepreneurs, really clever people, are incentivized to kind of build the worst systems. They're not incentivized to build on Bitcoin. And so I guess that's the kind of subversion that we're seeing now. So I think we're already seeing that kind of fight, but it's not a violent fight. And I don't think it ever gets violent, because, as I said, if it gets violent, then we 100% just win. Like, there's more of us, and people will just be like, what the hell? Like, why is this violent? What are you doing? These people aren't breaking any laws. Why are you violent? Yeah, that's just going to happen.
And the whole thing that I find so fascinating is that you and I are having a conversation about this right now. So I guess one of the first things to go in an escalated version of this battle is the ability to have this conversation, right?
Yeah. That's frightening. We already have ways around that. So, if we wanted to have this conversation in a much more adversarial environment, let's pretend that New Zealand is like North Korea, like North Korea. Let's pretend that we have drones like watching what we do or whatever, and the internet is severely controlled. We could have this conversation using encryption techniques. Hopefully, as long as we can secure ourselves in the meat space, which is harder. Let's maybe not go there, but we can secure ourselves in the digital space using encryption techniques and using tools like Sphinx Chat. And there's a new browser coming out called Impervious.ai. It's going to provide us alternatives to things like Google. It's going to provide alternatives to like Microsoft Word. And all those sort of the Office suite, and alternatives to Zoom as well. So luckily, we live in a universe where kind of all the bad things that happen, kind of we have so many clever people who are ridiculously intelligent, and most of them are anonymous, thank God. They're working on ways to build software applications that can allow us to step past any controls in the digital space. We do win because of those sort of people.
I do hope that that gets expanded to become more mainstream and more normal, because that's pretty much a good clue as to what you're going to be hearing here for a while, for as long as it's possible, right? Really important conversation to have. Now, as we wrap this up, I just want to give you an opportunity to kind of plug what you're passionate about, anything that you're up to on the side. One of the things that you did mention was the Mises Institute. Do you want to just tell me a little bit about this?
I really appreciate what the Mises Institute has done for me. And that sounds really, really soppy. That they don't know me at all. I haven't even donated to them, which is pretty bad. I guess coming out of university, I did a 4-year degree in economics, did a year of postgrad economics. I learned the neo-Keynesian way. I understood that. I understood the way that the rules of thumb were developed kind of for policymakers. It's for a very specific purpose, and it meets that purpose. That's fine. But something never really sat right with me. And then when I came out of university and became an economist, I started just like reading random stuff and I just stumbled on Austrian Economics and stumbled on the Mises Institute, and just kind of like exploring economics from that angle and building up that understanding from from the first principles of the fact that humans act, and then knowing how to build from that first principle to kind of the weird and cool things we have in the modern economy. That's been really powerful for me, and really it's changed the way I think. And so I guess I just want to give a shout out to them. That's kind of one of my passions, which is learning learning about economics, learning about the history of economic thought. Really specifically at the moment, I'm very interested in kind of the period from like the mid to late 1800s to the early 1900s, kind of all those events leading up from Napoleonic Wars, France losing a lot of territory, America kind of being built, the American Gilded Age, and then the American Gilded Age giving way into what systems were put in place to create the Federal Reserve in 1913. Then America's entry into World War One. Why? That's really interesting, like why these things happened, and sort of the economics of that, and kind of the philosophy at the time, the ideas which were prevalent, eugenics, rampant racism, of course. It was a very different world, but all those things kind of created our world. Like, I don't think there's enough appreciation anywhere for like how those decisions at the end of the Napoleonic Wars, at the end of the American Civil War, the end of the American Gilded Age, etc., how those decisions created what we see today. And I guess all those things kind of lead into the events of 1914, World War One, which then leads into the events of World War Two, which leads into all the events, and even during that time period, during the exact same time period, all this cool stuff's happening kind of in Europe, and not cool stuff, bad word. All this interesting stuff is happening in America and Europe. That America's Gilded Age, eugenics, etc. We also have the signing of the Treaty of Waitangi during the same period. But just what is interesting to me is the fact that it's happening at the same time as very specific things are happening overseas. And I would love to know more about the incentives and about the thought processes of all the people involved during that time period. Given my background, kind of Austrian economics, everything has to be about the individual making decisions. I absolutely reject the idea that there is a march of history. That's a very Marxist idea. And that line of reasoning is just false. But I think there's something in the whole cycle theory which might be related to just different generations of people going through building their own empires, building their own lives. Then maybe some of them, very few of them, get into like political office, and they don't go through the same thought processes. But I guess as humans age and as we live our lives, we do kind of tend to behave kind of similarly. And I think the cycles that we see are kind of caused by basically the aging of the people who are making decisions, I think. So, what we see in late 1800s, whatever, we saw a lot of one generation of leaders back then who lived through a particular time period and were influenced by their time period. They were influenced by a very prosperous time period. And then they came into power and they were 60, 70 years old. Their worldview was influenced by being so prosperous, but then they created this world where people weren't so prosperous because they didn't understand that prosperity requires different decisions than the ones they were making. So they created a very, very unprosperous world in some regard. The progressive era in America was kind of a time period where people's standard of living wasn't decreasing, but it wasn't increasing as fast as it could have been and as fast as it was during the Gilded Age. And I guess that's my theory of where these cycles come from. And that theory comes from a very ignorant perspective. I haven't spent a lot of time on this, but that's kind of my first guess as to where it comes from.
And I think what we're highlighting here really today with this conversation that we're having is just the importance that we need to encourage education, not just around how to get wealthy, right? How to invest. That's great. And we're definitely going to go there. But if you don't understand some of the plumbing, you're potentially not going to be on top of the change that's coming. We need to all be aware. We need to know how to communicate with each other because there's going to be some changes coming that will either move us or move right through us. So I think this conversation that we've had it's awesome. I hope that we can always have conversations like this, and I do hope that we can have a chat, you and I, together again soon. Konrad, just again, thank you so much for your time today. Really appreciate it. if people want to follow you, where's the best social media platform for people to follow what you put out there?
Just find me on LinkedIn, Konrad Hurren. I do have a Twitter, but I'm doing a little experiment with myself to see, what the benefits and costs are of remaining anonymous on Twitter.
So yeah, no, that's great. Thanks for joining me on the NZ Everyday Investor. There'll be a couple of links to some of the books mentioned in the show, and anything else that's of interest in the show notes. So please be sure to check that out. Again, thanks very much, and we'll catch you next time, Konrad.
Thank you, Darcy. It was fun.
All right, cheers.